I'm Scarlet. This is ETF IQ, where we focus on the access, risks, and rewards offered by exchange-traded funds. The Teflon market. Negative headlines abound, but nothing sticks to U.S. big-cap stocks. Eye of the storm. Protesters in Paris target BlackRock. The asset manager tries to tackle climate change, but ends up muddying the social investing waters. And seeking shelter can provide big returns if you're targeting home builders. We build a case for leverage bets on home construction. Now, love them or hate them, ETFs are here for the long haul, and their flows often signal broader market trends. So Bloomberg's ETF ninja, Eric Balchunas, gets us started with a look at the latest numbers.
Thank you, Scarlet. Big fan of ninjas, so I appreciate that one today. Let's look at what we have here. We are looking at last week, IVV and VU, the big retail S&P 500 ETFs, hauled in record amounts for each. Now we've got the trading crowd in with SPY, the Qs, J&K. They had seen outflows the week before, so the traders are back in. Institutions, liquidity, people who are looking for liquidity are back in this market. So the common thread here is U.S. large cap. There's a couple other interesting ones on the leaderboard, which is junk bonds, definitely seeing a bid. HYG and USHY, which is a broader version of HYG. And then also you've got LDM, which came in at 600 million. It's an ESG ETF. More and more we're seeing ESG on the leaderboard thanks to institutional seeding. Let's look at equities versus fixed income, because remember last year, it was the year of fixed income for many, many months. Exact opposite this year. Equities are firmly leading fixed income in flows. Equities have taken in $42 billion in about 6 weeks. It took them 6 months to take in $42 billion last year. So that's how bullish the flows are, at least for equities right now. And they're really concentrated in large caps. Let's look at different cap sizes, and you can see here, this is large cap. They generally get more because they're a bigger area. But look, small and mid, nowhere to be found. Normally there's at least a little trickle there, but this is all large cap. So Scarlet, nobody's even playing games anymore. They're just going after U.S. large cap equities, and they've got a bullseye on their back. All
right. This week's roundtable features Jay Pulaski, CIO and co-founder of TPW Investment Management, and Vildana Heinrich, a cross-asset reporter for Bloomberg News. Jay, you saw what Eric showed us in terms of the fund flows.
I did.
We're 6 weeks into 2020, and the 2019 playbook still applies here. Go big, go long on U.S. mega caps. Do the fundamentals justify the record highs that we've seen and continued outperformance of U.S. stocks relative to the rest of the world?
Well, I think the record highs make sense mainly because of three factors. We've had better than expected global growth data. We've had abundant liquidity, not only from the Fed, but also from the PBOC in China and elsewhere. And most importantly, I think we've had better than expected earnings, not only in the U.S., but also in Europe. The issue of investors, just as Eric said, going back to the old favorites. I mean, we had a period in November and December where ex-US outperformed, value outperformed growth, and cyclicals outperformed defensives. In January, all that stuff reversed. I think the people who questioned the rally hopped on the old winners. And most importantly, I think the long bond rallied significantly. And I think there's a direct, unusual connection between the long bond rallying down to 1.5% and large cap growth technology outperforming, because people value those cash flows in a different basis off the 10-year. So a lower yielding 10-year means you can expand that multiple on the other side. Right. So our view is that the fixed income market's going to reverse. Growth is coming back. The virus is just a temporary issue, and long rates will back up. Technology will not do as well, and the opportunity will reset into the ex-US value and cyclical trades.
Okay, well, speaking about the rest of the world, Vildana, the U.S. market obviously incredibly resilient, no matter what kind of headlines seem to crop up. How resilient are investors' faith in EM and international stocks? What are you seeing in terms of flows there?
Well, coming into 2020, there definitely was a sense among strategists that international stocks would for once again start outperforming U.S. stocks. And I think a lot of strategists are digging in their heels and saying that might still happen. They're just pushing out their outlooks into the latter half of the year because of the virus outbreak. And so if we take a look at a fund like EEM, for example, it's seeing some outflows, but nothing drastic. And also, just looking at China ETFs, they've been really interesting. They've been a sort of proxy for when Chinese markets were closed for a couple of days. And they also aren't seeing drastic outflows, but they are seeing huge volume spikes.
Yeah, and we just saw a chart of 3 different China ETFs. I think this really highlights the differences in China ETFs. You've got ASHR, mainland shares. You've got MChai, which is going to be broad, and then you've got KWeb, which is internet. Jay, talk about your play in China and how you pick it when you've got this much return dispersion.
Well, yeah, it's an interesting, significant difference in the last week or two with the virus. Because as people have been quarantined in China, life has moved online,
yes,
as opposed to offline. So the online has actually done better. KWeb has done better over the last 2 weeks than MChai or the A shares. And I expect that to actually continue, because as we come out of this quarantine period, our view is that we're going to have a kind of a doubling of the inventory rebuild we were just starting to get around the world. Now China, we've exhausted the inventory because of the trade fears in Q4 and the second half of last year. Now we've even doubly exhausted it because of the virus. So we think we're going to get actually kind of a sharp V.
Okay, so it's going to be replacement, not just lost inventory there. Vildana, a risk for 2020, of course, is the upcoming election. The Democrats' Iowa caucuses was a mess. The New Hampshire primary showed that Bernie Sanders won. How's the election factoring into people's investing?
There certainly is a lot of buzz around it. I think a lot of times your views on how politics might impact the stock market, for instance, will align with your actual political views. So there's a big group of investors who are saying a President Bernie Sanders might be negative for the stock market. And then there's also a growing group of investors who are saying, wait a minute, if there is a President Bernie Sanders, he might expand the budget deficit, which would act as a sort of stimulus in a sense. So I think it just depends on your actual political views. And I do want to caution that it's still really early on. We have months and months to go. And Wall Street in general doesn't have the very best track record in terms of predicting some of these political outcomes and how they might impact markets.
Yeah, I mean, I think Trump, everybody wasn't going to GLD. That didn't work out, right? So now we've learned our lesson. Jay, do you do anything, though? Because a new president would definitely change. It would be a catalyst in one way or another. Do you shift at all if Bernie keeps rising?
Well, I think it will be a catalyst in one way or another, right? The question is, can we pick which way? And the history shows that not really, right? And also, typically over the different administrations, there's very little difference in the S&P between Republican administrations and Democratic administrations. So our view is, no, we're not really making any trades based on who does well in whatever primary. I do think, though, if it is a candidate who ends up winning who's not seen as market friendly, that could facilitate more flows outside of the U.S. We're at very stretched situations technically on all of these factors. They're all the same trade in our view.
Yes.
Ex-U.S. is the same as value over growth, same as cyclical over defensive. The non-U.S. developed markets are cyclical value plays. And if we get the move up in growth that we expect and rates back up, that is what facilitates the move to value. That's what facilitates the move to cyclicals. And I think that's what facilitates the move to the non-U.S. equity markets.
All right, Jay Pulaski laying out what needs to happen there. Jay is with TPW and Bloomberg's Vildana Heinrich. Thank you both so much. Coming up, Bloomberg opinion columnist Nir Kaysar sounds off on ESG. He says BlackRock's recent pledge muddies the social investing waters. And one trend that caught our attention this week, UBS gathering more than 65 billion euros into its ETF products, reflecting the growth of those funds in Europe. This week, UBS's rival Credit Suisse Asset Management announced it's getting back in the game nearly a decade after exiting the business, as the firm plans to convert 3 of its index funds into ETFs. A reminder, by the way, you can catch Bloomberg ETF IQ Europe each Friday. This is ETF IQ. I'm Scarlet Fu. This is ETF IQ. Let's take you through the ETF Lifecycle, which has 3 main stages, and we always kick it off with the filing. Wedbush partners with the ETF Managers Group for a global cloud offering. The Wedbush ETF MG Global Cloud Technology ETF will be passively managed and target companies providing cloud-based infrastructure, software, storage, and other data management services. Step 2 is the launch. The iShares ESG MSCI EM Leaders ETF began trading this week. Ticker LDEM is passively managed and invests in large and mid-cap EM names with high ESG scores. Finland's oldest pension company seeded this fund with $600 million. And for some, the final stage is liquidation. The IQ Enhanced Core Bond US ETF is no more. Ticker AGGE was passively managed and used a momentum strategy to invest in the aggregate bond universe. Assets reached $100 million last year before collapsing to below $10 million this year. Time to get passive aggressive and track the tensions between active and passive investing. Now, activists are stepping up their campaign against BlackRock, this week barricading the asset manager's Paris office. CEO Larry Fink has vowed to fold sustainability into BlackRock's investment approach, but critics say that is not enough. According to Bloomberg opinion columnist Nira Kaysar, BlackRock is taking a misguided approach to climate change. He joins us now. And the root of your argument is that BlackRock's pledge sounds straightforward, but it's anything but. And that's because there's some definitional issues here at play. There's a difference between ESG and socially responsible investing, SRI. Explain the difference.
Hi, Scarlet. Yeah, I'm afraid that Larry Fink has fed the fire rather than put it out. And the way he's done that, I think, is that I think the move further muddies a point of central confusion. And the confusion is that when people are buying these funds that they think are that will reflect their values, what they're really buying is a smart beta strategy. So they think they're buying something that is generally called SRI, which excludes certain companies, certain industries that they find objectionable for various reasons. But what they're really buying is ESG, and ESG doesn't really care about values. It's just looking at various environmental, and sustainability and governance factors that are supposed to be indicative of better performing stocks, either because it will reduce risk or because it will actually increase absolute return. And that confusion, I think, is causing people to say, hey, look, these funds are actually not doing what I think they're doing. And the reason is it's not being explained to them properly.
Now, let's talk about one of BlackRock's funds, which is ESGU. It has about $3.7 billion in assets, and that's largely because BlackRock put its model portfolio in there and moved over client assets. That accounts for the big boost in inflows. If you look at the return, it's almost identical to the S&P 500. It also holds companies like Exxon and Chevron, which surprised me, at least initially. Would this be an example of ESG or SRI?
Well, the problem is that a lot of these funds do both. But I think that this really points to a second problem and this particular fund highlights it, which is that with any factor-based strategy, which ESG is, you can have more or less of it. And so in some cases, you're going to look at these funds that are going to look a lot like the market, and investors are going to scratch their head and say, why am I buying this fund if I'm effectively buying an S&P 500 fund? And the reason is what you're buying is you're buying an ESG light fund. You're buying a fund that does apply ESG factors, but it applies it in a way that looks a lot like the market so that the tracking error is going to be low. But if you think you're buying a values-based fund, you never even get to that question, and that's sort of the second derivative problem that we're talking about.
Yeah, it's a watered-down version of the S&P 500. All right, here's another BlackRock fund, which is SUSL, SUSL, which goes after the leaders in ESG. But by doing so, it doesn't hold many of the big FANG names. We're talking Facebook, Apple, Amazon, Netflix, those big performers. So when it comes to returns, Eric likes to compare it to a car without an engine. Where does this kind of fund fit into your two camps?
Right. So this is mostly an ESG fund, and this is really ESG on steroids. This is for people who really believe in ESG. And if I were extending Eric's analogy, I would say that, hardcore ESG folks look at a fund like this not as missing an engine, but as taking out a ticking time bomb. And the ticking time bomb is really the stocks that score low on ESG, and even though they might be doing well now, they're eventually going to blow up the car. And that's the key insight. The key insight is that people who believe in ESG will look at what's driving the market today and say, we don't really care about that because ultimately we think these companies that score low on ESG are going to blow up the portfolio, and we don't want them in the portfolio. And that's what this particular ETF will do. Got it.
Now, another interesting issue that Eric likes to bring up a lot, certainly in his research, is Berkshire Hathaway, which is in fewer ESG ETFs than ExxonMobil because Berkshire doesn't have any independent board seats. And Buffett says that's just something he's not going to bother himself with. Is this an example of why passive ESG funds are inferior to active ETF investing? Because that way the babies are thrown out with the bathwater in these passive approaches.
Yeah, I mean, you could look at it that way. I mean, it's certainly a limitation, I think, of any quantitative type strategy, which I would say ESG is. it's not going to look at blurred lines. It's going to draw hard lines, and whatever the screen says, it's going to say. But there's a related issue with Berkshire, which is that not only do they not score well, but they're also famously not willing to give investors the information they need in order to screen on these ESG factors. My guess is that's a war they're eventually going to lose. They don't care now because there's plenty of money coming for Warren Buffett. But eventually, I think the market will demand that information, and I think regulators might even hop on the bandwagon and ask them to disclose those things.
Very quickly, Nir, the broader question here is how much of ESG is just spinning its wheels? Because if investors are still consuming goods and services from a lot of these companies, how does that really make a difference? It's not as if people are giving up driving or flying.
Right, that's a really good point. And I think also you have to distinguish between ESG and SRI. I mean, ESG is not asking anyone to change their life. It's just saying we think this is the best portfolio performance-wise. SRI, on the other hand, is a values-based play. And so the question for investors is, do they think that by starving these companies of capital, they're actually going to affect change? I'm very skeptical. I think that if they want to affect change, they're going to have to do it from the demand side, because as long as they're buying the products, as long as they're giving revenue to these companies are going to continue to thrive.
All right, so those protesters against BlackRock, an example there of SRI. Nir Kaysar, thank you so much, Bloomberg opinion columnist and founder of Unison Advisors. Now, coming up, one of the most notable investing stories of 2020 has been Tesla. So next, we dig into an ETF that tracks battery technology. And for a drill down into all of our ETF content, check out bloomberg.com/markets/ETFs. This is Bloomberg. I'm Scarlet Fu. This is ETF IQ. Now, for every ETF targeting a sector or a theme, others are quick to follow suit. Tesla's surge has changed the fortunes of all the ETFs exposed to the stock. And the latest beneficiary is the Global X Lithium and Battery Tech Fund. Global X Head of Research and Strategy, Jay Jacobs, is here with us now. But before we talk to him, Eric Balchunas is going to give us the drill down into that fund.
Thank you, Scarlet. Yeah, the Global X Lithium and Battery Tech ETF basically tracks global lithium miners and battery producers. It's a classic theme ETF in that it goes across a bunch of sectors, including chemicals, miners, auto, electrical, and has a variety of countries in there. Pretty big at 650 million, 75 bips, a little on the high side, but for a theme that's pretty normal. Let's look at the holdings. And this is what caught our attention this week is Tesla. This is one of the ETFs that owns the most Tesla, number 3 here, at a 6% weighting right there, 11% rather. So Tesla really driving this thing lately. Let's look at the performance of this versus the all-country world index, which is all I could think of to put against this because it's so unique. And you can see this is the all-country world. This is lit. So you're going to get a lot of volatility here. They both end up about 50%. So I think, Scarlett, this is going to have to come down to whether people are really into this industry and the whole battery theme. But there are some opposing forces in the portfolio they have to watch out for.
All right, way to incorporate lit into your commentary there, Eric. All right, still with me is Jay Jacobs of Global X. Jay, what is the case for buying lit to capture a performance like Tesla versus just buying the star performer itself, Tesla?
Sure. Well, I think Tesla is kind of the poster child of the electric vehicle revolution, but it's 11% of our fund. That means 89% of the fund is other things besides Tesla. You have battery producers, you have lithium miners. There's a much bigger ecosystem that is supporting the rise of electric vehicles beyond just Tesla.
Yeah, and with that, one of our analysts was saying how, well, if the price of lithium goes up, that's good for the miners, but then bad for the people buying it. Are those forces working themselves out in the portfolio? How do you account for those?
It's actually kind of a misconception because lithium makes up about 3% of the cost of a battery. So lithium prices can rise, but you can still see falling battery costs because battery producers are getting more and more efficient. To give you some context, about 10 years ago, batteries cost about $1,000 a kilowatt hour. Now they're $100 a kilowatt hour. And lithium prices, have actually risen over that time frame. So battery prices are still falling even as lithium prices increase.
You mentioned that Tesla makes up 11% of the fund. How does it work when an individual stock gets this hot? I mean, this is a market cap weighted ETF. How does the ETF respond? How big do you allow any one name to get before you rebalance and take down some of that influence?
Yeah, so when you create an ETF, you always have to think about these things. Do you want to have just completely a free float market cap, or do you want to have caps on individual position sizes? The lithium space is a bit unusual because it's super concentrated. You have 5 lithium miners that produce about 66% of the world's lithium, and you have 4 battery producers that are kind of the controllers of battery production. So we have a pretty high cap on an individual position size because it's so dominant.
What is it?
It's about 20%.
Oh, so it can get a lot bigger.
Yeah, and another one you have is Drive. It's electric car ETF, and Microsoft is the biggest holding. So what's the case for Drive versus Lithium, and why is Microsoft the biggest holding? That could be a knife quick.
By the way, Tesla is in Drive too, right?
Yeah, Tesla's in that one too.
So I think ETF investors need to get comfortable with this idea of intensity, right? This can work for factors, this can work for ESG, it can work for thematic ETFs. How much do you want narrow focus on an individual area, or do you want to be broader and own the ecosystem? Drive is kind of our broader exposure to the electric and autonomous vehicle space. So it's pulling in companies like Microsoft that build the cloud solutions for autonomous vehicle technology, and it pulls in the Teslas, and it pulls in the lithium miners. Lit is just that really focused approach of just those mining and battery companies.
All right, got it. Jay Jacobs of Global X, thank you so much with the latest on their thematic ETFs, Lit and Drive. Now, the ETF industry has something for everyone. It's something we like to say. Low interest rates are the tailwind for a lot of markets, but none more so than housing. In this week's There's an ETF for That, we highlight a fund that allows you to triple down on that bet. Strap on your tool belt for the Direction Daily Home Builders and Supplies Bull 3x Shares ETF. The fund's name is a mouthful, but the ticker isn't. It's simply NAIL. This leveraged ETF seeks 300% the return of its benchmark index for a single day. On top of that, NAIL is more of a pure play on just home builders, giving it extra zip over other home builder ETFs, which tend to include a lot of retail names. Bottom line, NAIL is not a buy and hold investment. It's not your typical ETF. It's much riskier. The danger is hammered home by NAIL's rating in the Bloomberg Intelligence traffic light system, a red light with 5 warnings. The fund has some 45 market cap weighted holdings with half and large caps. Top names include D.R. Horton, Lennar, NVR, Pulte Group, along with Sherwin-Williams. NAIL has around $75 million in assets and an expense ratio of 95 basis points, in line for a leveraged ETF. And NAIL was one of the best performing ETFs of all of 2019, but no one would ever hold on to it for that long.
Yeah, we always eliminate those. It's like including steroids when you're looking at your leaderboard. You don't want to. This year, the best performing is GasX, which is triple leveraged natural gas. But then we don't count that. We always, it sounds like medicine.
Certainly does. All right, that does it for Bloomberg ETF IQ. Be sure to catch us each Wednesday at 1 p.m. New York time, 6 p.m. in London. From New York, this is Bloomberg.